The following section provides a news report from a business magazine that describes the events leading up to the bankruptcy of a public company. In this scenario, assume that stockholders lost significant amounts of money when the company declared bankruptcy and are exploring the option of filing a class action lawsuit against those responsible for their losses. While reviewing the information provided, we ask that you consider the situation from the perspective of a potential litigator, a lawyer leading the class action suit, and carefully consider who is to blame for the failure and who should be held responsible for compensating stockholders for their losses. After you review this scenario, you will be asked for your opinions about the situation to gain your perspective on the options available for stockholders to recover their losses. Assume that you are providing crucial advice to these stockholders and that they will rely on your opinions. News report. The blame game begins as Clovatec Inc. declares bankruptcy, February 20th, 2009. Clovatec Inc., a manufacturer of computer accessories in the U.S., recently filed for Chapter 7 bankruptcy protection. This announcement follows the company's recent disclosure that individual sales representatives in multiple regional offices have admitted to inflating revenues to meet projections and concealing significant declines in demand for their products for the past 18 months. The activity had been occurring since the beginning of 2007. In 2007, the company reported sales revenues of $400 million and reported an overall profit of $200 million for the year. The independent auditor for Clovatec Inc., a large international accounting firm that has performed independent audits for Clovatec Inc. for 3 years, had previously reported a clean opinion on the financial statements and internal controls over financial reporting for 2007. After discovering that revenues had been inflated, the company restated their 2007 financial statements on February 11, 2009, decreasing sales revenues by over $200 million and resulting in an overall loss for the year of $10 million. On the day the restatement was announced, Clovatec Inc. stock dropped 50% in value from $28 to $14. Only 1 week later, following the bankruptcy announcement, the stock is considered worthless, with total losses for this group of shareholders estimated at $100 million. Details emerged following last week's restatement announcement that Clovatec employees were involved in a scheme known as channel stuffing, where individual sales teams were distributing excess inventory to retailers near the end of each quarter to meet short-term revenue projections. The sales teams were able to convince retailers to overstock their products by offering retailers extra incentives, for example, highly favorable credit terms of 6 months or more with no interest. The scheme was uncovered when significant decreases in demand for the product caught up with the company, as retailers were no longer able to sell the product in their stores and stopped ordering more stock from the sales representatives. This scheme is considered fraudulent since the employees were receiving excess compensation based on intentionally manipulated revenue figures. Multiple employees have admitted to intentionally overstating revenues for personal benefit. The restatement of the financial statements was also accompanied by management's disclosure of a material weakness in the internal controls over inventory, stating that the internal controls established by top-level managers within the company were ineffective. Company policy overemphasized meeting short-term profit goals at the sacrifice of internal control at the sales division level. This weakness in internal controls contributed to the fact that employees were able to falsely inflate sales revenues without being detected, resulting in significant overstatement of sales revenues and profits in the financial statements of Clovatec Inc. for 2007. The Clovatec Inc. bankruptcy has sparked criticism of the implementation of the internal control requirements outlined by the Sarbanes-Oxley Act of 2002. According to the Sarbanes-Oxley Act, managers of public companies are responsible for establishing and maintaining effective internal controls over financial reporting. In addition, their independent auditors are required to conduct an evaluation of internal controls and release a report that communicates their findings. An audit committee, consisting of members of the board of directors, oversees the audit process and resolves any issues that arise during the audit. Preliminary reports suggest that the sufficient internal controls could have prevented or detected the significant overstatement of sales revenue, so the managers, audit committee, and independent auditors of Clovatec Inc. may be vulnerable to scrutiny for their reporting decisions in 2007. Clovetech's managers, audit committee, and auditors have communicated that they were all aware that the deficiency in internal controls existed at the time of the 2007 report, but all three parties decided that the deficiency was not serious enough to jeopardize the reliability of the financial statement figures. Although management and auditors had disclosed the deficiency in their reports on internal controls, both parties reported that internal controls were effective overall, and the auditor reported that the financial statements were fairly stated. Sources close to the case are now asking if one or more of these three parties should be sued by shareholders to recover their losses. The answer will ultimately depend on whether appropriate standards were followed and how viable the case will be from a legal aspect. In this particular case, the independent auditor for Clovetech Inc., ABC CPA firm, had previously reported that the 2007 financial statements of Clovetech Inc. were fairly stated and that internal controls within the company were effective. Both management and the auditors had previously disclosed within their 2007 reports on internal controls that there was a significant deficiency in the internal controls established by top management. This deficiency was ultimately deemed in February 2009 to be the primary contributing factor in the lack of detection or prevention of the channel stuffing fraud and the resulting significant overstatement of the 2007 sales revenues. The auditor released a statement last week communicating that their audit team, open quote, had identified the deficiency in question during their audit of internal controls in 2007, but had concluded that there was not sufficient evidence to suggest that internal controls over financial reporting were not effective, or that the deficiency would place the reliability of the financial statement figures in question. However, we voluntarily disclosed this significant deficiency in the control environment within our report on internal controls. Thus, we feel that our decision to provide a clean audit opinion on both the financial statements and internal controls of Clovetech Inc. was justified based on the evidence we had at the time. An executive of Clovetech Inc. also released a statement corroborating ABC CPA firm's account of events, stating that, open quote, ABC CPA firm had in fact communicated in a formal letter to the audit committee their concerns over a significant deficiency in the internal controls established by top management during the audit of the 2007 financial statements. The issue was discussed in an audit committee meeting with management, auditors, and audit committee members present, and all parties agreed that there was no reason to believe that internal controls were ineffective to the point that they would not prevent or detect a material misstatement or fraud in the company, and there was no evidence that the current financial statements were materially misstated. All parties also agreed to provide a voluntary disclosure of the significant deficiency in the control environment in their report on internal controls, but concluded that there was no evidence that the current financial statements were materially misstated. Therefore, management and the auditor both concluded that a clean opinion on the overall financial statements and internal controls was justified, and that they went above and beyond professional standards by voluntarily disclosing the significant deficiency in their reports on internal controls. Preliminary estimates suggest that stockholders purchased a total of $100 million in stock in the months between the release of the 2007 financial statements and the announcement of the restatement. The stock is now considered worthless, with 50% of the decline in value occurring on the date of the restatement announcement, and the remaining drop in value occurring on the date of the bankruptcy announcement, shocking investors with a $100 million loss in stock value from a company previously considered to be a solid long-term investment. Although no parties have filed a lawsuit against the company, the audit committee, or the independent auditors, investors will likely be looking carefully at the events leading up to this bankruptcy to decide who is to blame and who should be held responsible for their losses. Similar cases in the past have resulted in class actions shareholder lawsuits against one or more parties, such as the company executives, the independent auditor, and the audit committee, alleging a range of offenses such as negligence, negligent misrepresentation, and fraud. You have now concluded the audio-video portion of this task. Please click Next to continue to the next screen.